Hi, this is the September 6th version of Transaction Review and Calculator Practice. Okay, so for now on, we'll just have to use the chat button, and I'll try to unmute if we can a little bit later. But tonight, we're going to be going over private loans versus discounted notes, and which really leads us to talking about interest only versus amortizing loans. So tonight, this was based upon our last virtual coffee chat I think it was just last Saturday or the Saturday before. And this topic came up, and it's kind of confusing when you figure out, what are the pros and cons to interest only notes and amortizing notes and such and so on and so forth. So first, we're going to go over two tables that look kind of like this just to get a lay of the land, and then we're going to go over two examples with our calculators. So if you have your HP 10B2 in handheld form or the iPhone app by In a Day Development, you can get that out now, because actually I'm going to show you how to do that on both. I was at Gary Johnston's Freedom Financials Principles class this last weekend, and I know maybe some of you have probably taken that before, and it's just really excellent. And I've actually never known how to use the handheld to get the amortization schedule to work, so I learned that this weekend, plus a lot of other good perspectives. So I'm going to share what I have learned with you. Okay, so here we go. We have, right now we're going to be, when you're investing in paper, or investing in notes, some people call this private lending in this column here. Some people call that buying trust deed investments. It's the same kind of deal, right? Because you've got a note that's secured by a deed of trust. You've also got notes that are secured by mortgages in some states in the U.S., but for California, people call it trust deed investing generally, but they're talking about buying notes. The security instrument is a deed of trust. So we've got private loans, and then we've got discounted notes, which is usually private paper, not always, but for all intents and purposes, I'm only going to be comparing the kind of discounted note that I will typically buy, which is a private note, not an institutional note, which means it's not a bank note, not like a non-performing bank note or institutional performing pool or something like that. And I'm not buying non-performing, I'm buying performing. So this is what we're going to be discussing, the differences right here. So the first thing is term. Term for private loans, if you're investing in loans, you just want to be a private lender and you're originating. Remember, loans, this is the primary mortgage market because you're originating the paper, right? Discounted notes is the secondary market because you're buying paper that was created before you got into the picture. Okay, so the term. Now, for private loans, most people think of pretty short terms, usually like 6 months to 2 years, because that's like the guys who need to borrow money to do rehabs and flips and things like that. Sometimes it can go out to 8 years. An example of that would be the Norris Group has a buy and hold program for investors where they'll lend them money at 10% for 8 years, interest only, okay? And so they don't have to worry about refinancing really quick. But most private loans, most people, when they're doing this, have a really short window of time in their mind. They want their money out to work for 6 to 24 months, and then they want their money back, okay, in their pocket. Now, someone who's buying a discounted note could buy typically anywhere from 3 years up to 30 years, right? If somebody writes a 30-year note and wants to give it to you at 50 cents on the dollar, why wouldn't you buy that? Because statistically speaking, that's going to pay off in 7 to 10 years anyway, correct? Okay, but if it doesn't, you still buy at a yield that you can swallow if you somehow have to go out 30 years, okay? But typically, I would say most discounted notes fall in this 3 to 10 years. Maybe I'll change this to 12. 3 to 12 years, something like that. So I would say most of it falls somewhere in that range. So you can see it's a little longer term perspective than private loans. Okay, now let's look at the interest and yield. On private loans, you can get anywhere from, actually this is actually lower. I've seen people be happy to get 8% on a loan that they liked. Okay, 8 to 15%, with most of it being in that 10 to 12% range. So this is like your hard money lender, right? Private lender rates, 10 to 12%. And discounted notes, if you are finding the deals yourself and you're using your own money, you can make a minimum of 8%, I would say, and there's no ceiling here on the yield. That's why I like discounted notes over lending. I probably do maybe 20% loans, 80% discounted paper, because this is way more fun, okay? Because you have upside here, and we'll talk about that more later. Please, again, type in any questions that you have over to the right in that little chat button, or whatever box that is you see. Okay, type of interest, the type of repayment, these are almost always interest only. Okay, that means you get your interest payment each month and that you get a balloon payment that was equal to the loan that you made. There are some exceptions, obviously. I mean, just two months ago, I funded a private loan that was amortized over 30 years, due in 5. Okay. All right. Now, discounted notes are almost always amortizing, meaning you get some principal back each month along with your interest. Okay. Amortizing means by the end of the term, that loan is killed. Mortir, dying, mortician, okay? That means the note is dead at the end of the term. So now let's go here to LTV/ITV. LTV, loan to value, is referring to when you're originating a loan. ITV, investment to value, is when you are buying and investing in a discounted note. Okay, so LTV, now let's just get real here. There is a lot of money floating around looking for loans right now. If you go to an investment club and you see who's like the vendors or the affiliates or whatever, there could be like up to 7 hard money guys in one room in one night. Everybody's looking to invest money, so that means to be competitive, you have to be low interest rate, and this is just generalities, and you have to be willing to go up to 70%, or sometimes I see people doing 90% of ARV, which is after repaired value. That simply means that if a property's worth $100,000, your loan amount could be $70,000, which includes what the property will be worth, not what it is worth today, but what it will be worth when they fix up the property. Okay, so LTVs are kind of on the high side, 70% and more. Like I said, some people are doing 90%, which to me it's like, wow, you really got to trust the people you're in business with, have a high appetite for risk also. I would say usually you're going to at least be going up to 60%, although that one private loan I funded earlier was actually at 50%, maybe just a teeny bit less, okay? Because I tend to be, if I do a loan, I like it to be pretty conservative, less than 60% of the value of today's value of the property before repairs. Okay, so that's what you can see. Because of my conservative nature, I don't do a ton of loans. Okay, besides they're not as fun to me as other things. But investment to value usually It's the highest most people will go, and of course there's crazy people willing to go higher on here too, but usually the max is about 65% of the value of the property, and usually I would say almost, I actually cannot think of a discounted note that I've bought where I'm not, I would say 90% of them are well below 50% of the value of the property, so I have a lot of safety there. Where the collateral is. For private loans, usually they're pretty local, okay, because you have to have a broker's license in the state where you're putting the deals together. So for me, if I do a private loan, it's got to be in California, and usually it's Southern California, where if I had to, which I usually do, always go drive to the collateral and look at it myself, okay? So usually they're local, usually California only, whereas discounted notes, for me, I'll go anywhere in the U.S. that the numbers make sense. But I prefer deed states because the foreclosure process is usually quicker and easier and cheaper and more predictable, okay? How much capital to start? If you want to be a private lender, I mean, just think of where I am in Southern California, right? It's hard to make a loan for less than $50,000, and I would say usually the sweet spot is for you to have $75,000 to $500,000 to be able to really make a dent and do something as a private lender. Whereas for buying discounted notes, if you've got at least $10,000, now I don't, obviously the more you have, the easier it is to work with, but I have had a couple small deals, and my smallest ever deal was just recently. I had someone come in that was just the cutest person. She's just took me out to lunch, and she's real aggressive, and she's working hard, and she just says, I've got this $3,000 that I really want to start investing in notes. And at the time I was thinking, okay, maybe, why don't you look for some partners or something? But then I ended up getting this, I was buying a portfolio of 4 notes, and one of the notes was really, really small. So I was able to take as the smallest amount I've ever taken from an investor is $3,250, partly because I really like this gal, and partly because it was unusual that I bought that small of a note. Okay, so you can see that you can get started in general with much smaller amounts than if you want to be a private lender. And who pays for default? Like who has to pay if this note quits paying? Who has to pay for foreclosure and worry about reselling the property? The lender does. Okay, if a broker brokers you a deal, or I guess you do it yourself, obviously you're on the hook. If the payments quit coming in, the broker's going to go, okay, good luck with that. Go, here's the name of someone that can help you start the foreclosure process, and you're going to have to put that money out of pocket. I would guess anywhere from $2,500 to $7,500 all told, depending. Now, if you're buying a discounted note and it goes sour, it's the same thing. If you're the note buyer and you're on your own, you have to pay for it. If you and I are working together and I'm managing the note, then I pay for it. Okay? So that goes back up to here that I think I forgot to mention. When I'm managing a note and I guarantee that I will pay for foreclosure and manage the asset and manage the resale and do all that blah blah blah, then I pay my investors 8 to 9% so they can just sit back and never have to worry about a thing. Okay, if they don't want that from me and they just want me to broker the note to them, that means just take a fee out front and let them have the note. Then that you can make in that 10 to 14% range, but in that case, it's on you. Anything that comes up, it's up to you to deal with, and unless and only members of the community, will have access to my support. Anyone else who's not a member of Owner Financing Club will just have to figure out what to do. Okay, so I would say most of the notes that I'm buying, I would say 75% of the discounted notes I'm buying are with people who just want this program here. I rarely broker notes, but I probably will consider it, especially to members of my community, if they want if they want that. Okay, so potential upside bump. Okay, for private loans, you're going to make your yield. If it's 10 or 12, that's what you're going to make. Okay, there's no upside in it. Unless, okay, if you end up foreclosing and owning a property with equity, I guess that's a bump. Okay, you could get the upside from that if you happen to still have a significant amount of equity when you take the property back. With discounted notes, yes, there's an upside, a potential upside, even if you don't have to foreclose and take the property back. Because, and we're going to go through this in a minute with the calculator, because if, let's say you bought a note that you bought it at a 10% yield, and you didn't expect all your money for 7 years, but what if they sold the property or refinanced and you got paid off in 3 years? Okay, we're going to go over an example, and that will greatly increase your yield. Of course, if you end up foreclosing, then you have the property that you can keep as a rental, or you can resell for a profit. And of course, if you have to foreclose, the lower your LTV, ITV, the more potential profit you have in the deal. So if you foreclose on a loan where you're at 70% of after repaired value, and guess what, they didn't end up finishing the repairs, then you might be at 100% loan to value by the time you get that property back. Okay, your protective equity might have disappeared. And I know I'm throwing out a lot of words really fast, so don't hesitate to ask questions. And please get on that virtual coffee chat at this last Saturday of every month, because that's a really fun way for us to sit on the phone and just sort of, yak about stuff and answer questions. But if you're in only at less than 50%, you have to foreclose, your upside in the property is usually better. Okay. So, and I'm assuming these things will make more sense once we kind of get to the calculator part. So now just to look at the table another way, and I hope you guys can see this okay, but in this column we have interest only. Remember, here we have private loans, which are usually interest only, and discounted notes, which are usually amortizing. So now we've got interest only here and amortizing here. For accounting for interest, when you have an interest only loan, super easy to keep track of, right? Every payment that comes in is just interest, and you know that in 6 or 12 or 24 months or whatever it is, you're going to get your principal back in one big chunk. So for accounting purposes, super simple, right? If it's an amortizing loan, you need to be looking at an amortization schedule, which you get, or you can create for yourself if you don't. And you have to, because you're getting a little bit of principal back with your interest, so you got to know which is interest and which is principal. Let's say for people who are just trying to live off the interest and not eat up their principal. So it's very important for them to distinguish how much of that payment that comes in is what, right? So it's a little more labor intensive. You got to look at the amortization schedule and figure it out. Investment capital. Okay, when you're in an interest only loan, that principal keeps working consistently for you. It works the exact same amount because the principal never decreases, so it just keeps out there working for you. You don't get it back. When you're in an amortizing loan or note, you are getting some of your principal back. So as soon as you get some of your principal back, that principal is no longer working for you, right? They've paid it back, so now they don't owe you interest on that part. So you have to assemble the principal as it comes back, and if you don't need to live on the interest that you get, you can be collecting both your principal and interest into a payment until it's big enough to invest in another note. And in that way you can compound the returns that you're getting by being able to reinvest not only the principal but the interest as soon as possible. Okay, so now you're going to have to be looking for ways to put your principal back to work as you get it. Okay, now we're looking at loan to value or investment to value, depending on whether you're making a loan or making an investment in a note. Okay, the loan to value stays constant, right? Let's say property prices stay the same, then your loan to value will stay the same because the principal amount doesn't move. But if prices go down, what if there's a 10% softening in real estate prices? Okay, what if interest rates go up, which means prices of houses will go down? That means your loan to value can easily increase. If a property price decreases by 10%, you can easily find yourself from a 70% loan to value loan into an 80% loan to value loan. Okay? Whereas with amortizing discounted notes, your ITV decreases month to month. Okay, so that means with every payment, since you're getting some of your principal back, your investment to value is actually going down. Okay, with every payment, it's getting a little safer because you have less of your principal at risk. And even if prices in real estate drop a little bit over time, your ITV, investment to value, will stay constant because the principal is decreasing even as prices of the property are decreasing. So, and I got to make a picture of this. I'll try to do that at some point. Make a picture where it's visual instead of me just yakking at you. But okay, so protective equity, this is the opposite side, right? Protective equity is that cream that's floating on the top that protects you. Okay, so with interest only, the protective equity, just like, loan to value, it stays constant if the value of the property stays constant. Okay, it can easily decrease. If there's a 10% decrease in the value of the property, you're going to have a 10% decrease in your protective equity. That equity in the house that's on top of your loan that is there to keep you safe in the worst case scenario. With amortizing loans, your protective equity increases month to month because you're getting some of your principal back. So the loan balance is smaller and smaller and smaller with every month. At the worst, like I was saying, even if prices soften up a bit in real estate, because you have an amortizing loan, your protective equity keeps pace. So at least you're going to have the same protective equity generally that you started with, but usually it increases over time. This is more risky because if there's price deflation in real estate, you're more and more at risk with your capital, where with an amortizing situation, you're constantly getting safer and safer and safer with each monthly payment. And so if something goes wrong in even more in the market, you're doing okay. All right, idle funds. We sort of touched on this with when you have short terms, remember loans and interest only things are usually, most people want to be out, don't want to be committed more than 2 years. That means that your money might sit idle between deals, right? So you've got your money making, let's say you're making a fat 12% return on the face of your note, but then for 6 months out of every 2 years, you're looking for your next deal and it's making nothing, waiting, right? So generally, the overall returns will be in that 8 to 9% yield, even though you every time you do a loan, you're at 12%. By the time you annualize your returns, usually you're at this, sometimes even less. 7 to 9% isn't uncommon for people who are chasing yield and they got to have it working at 12% or nothing. By the time you figure all the time they're sitting around waiting for the next deal, they're really at this most of the time. Okay, amortizing loans, even if you pick the managed version here at 8 or 9%, you're going to get that. Plus, if you can put your capital back to work as you get it, remember you're getting a little bit of your principal back each month, then your overall return is going to be much higher than this, okay? If you're putting it back to work as you get it, and especially if you don't need to live off and use the interest that you're making. So it's at least this, and there's all this upside, okay? And if you're on your own program, 10% is going to be usually a typical bottom for you, and then you have all the upside that we talked out before. Any questions? Gosh, we've already been going a half an hour here. So let's just get to, type in anything you need to over on the side. Okay, so now we're going to get to compare, contrast two deals. And so I'm going to pull up my little HP 10B2. Okay, here we are. All right, let's say we did a private loan. I'm going to clear all. Okay. The collateral's worth, the property's worth, this is a rehab flip, let's say it's worth $153,500 after repairs, and you're willing to land on that because the people doing the job you trust, okay? You feel good about it. So the loan amount is $100,000, or let's say they bring it to you and they say, the property's worth this, $153,500. How much will you loan me on it? So you'll say, I'll go up to 65% after repaired value. So remember, move the decimal 2 places to the left. So times 65 equals, I'm a little bit off there, but let's just be generous with me and let that be 100,000, okay, since I'm trying to do this example. Okay, so $100,000 loan. Let's say they're willing to give you 11%. Okay, most private loans are in that 10 to 12 range. Some are lower, some are higher. So let's figure out, and they only need it for 9 months. Okay, they think they only need it for 4 months, but you're going to double that and give them 9 months just in case something goes wrong. Okay, so 100,000 at 11%. So remember, let's move the decimal point over to the left 2 times, times 0.11. Okay, that 11,000, that's for an entire year. So let's figure out per month. So 1 year, 11,000 divided by 12 gives us the interest for each month, which is $916.67. And then that's what you get every month. And then at the balloon, at the end of 9 months, you get your 100,000 back that you gave in the beginning. So the total interest over that 9-month period is $8,250. See, we take the monthly payment times 9, $8,250. And if you figure the last 3 months of the year you are empty, looking for the next deal, then we have to take, this is how much you made for the year on your $100,000. So let's divide by $100,000 equals 8%. You really, even though you had an 11% yield here, your annualized return was still 8%. Any questions? On the other side, we've got a discounted note. Okay. In this situation, I'm going to do clear all here. The collateral, that means the property underneath securing the loan, is $50,000. And the note purchase, let's say we paid $25,000 for this note. Okay, and maybe it was a $30,000 note or a $35,000 note, and we bought it for $25,000. So our ITV is 50%. Remember over here we had an LTV of 65% after repaired value, and this is 50% of after repaired value. Okay, this is a 9% amortizing loan that you bought. It's fully amortized over 7 years, right? 7 times 12 is 84 months. So this isn't exactly right. This is just for example. So even though that it'd be slightly different numbers, but I think you're going to get what we're talking about. So let's say you bought the note at 25,000 and you bought it at a 9% yield, and it's amortized over 84 months. So we put that in N. That's number of payments. Okay, and then the future value, which is the balloon, is nothing. There's no balloon there, so that's 0. And then so we click this and we figure what the payment is, 402.23. So like here, the balloon is nothing. That's why future value is 0 over here. So let's see, what's the total interest that you will make? Okay, so I'm going to go over to this right here. Okay, here's another, Ryan, I know you're a Mac user. I just discovered this. I was using VirtualBox, which is freeware, and I just found Parallels. It was like, I don't know, $80 to get it, but it's making it so easy for me to run PC programs on my Mac. So there's just a little FYI. Okay, so here's T-value. It's a PC-only program. So what we did here is we had a loan, and I don't know if you can see this, but the loan, and I can't make this bigger for some reason, but 25,000, and then we have 84 payments of 402.23, and then if you click over here to the amortization schedule, here's the payments that were made, here's all the interest, and here's all the principal, and here's the balance of the note. So as we go through year 1, year 2, year 3, 4, 5, 6, 7, what we find is at the bottom, okay, we got back our principal, 25,000 that we had in, plus over that 7 years we made 8,787 in interest over that same time. Okay, and so when you plug that in to the system, see there's 9%. That's a guaranteed 9% yield, even though you got principal and interest back. That's what the yield is on the note. But we know that the payment can, if you get paid off early, you have a potential bump here, right? You could potentially increase your yield. And let's go over an example of that. Where'd that just go? Oh, okay. All right, so let's figure out that I'm going to make a whole new program, okay? All right, so what we're going to do here, let's say there was a $50,000 note, and let's say it's just really solid. The property value is $100,000. So already it's already good at 50% of the value of the property, and because we're going to discount this, we're going to be at below 50% ITV. So let's just see what happens. Okay, if that's the PV, right? That's the one mom and pop, they're getting ready to retire and move into the nursing home, so they sold their rental property. It was worth $100,000. They took $50,000 down, and they carried a $50,000 note. Okay, so they have this $50,000 note. That's the present value or loan amount. This happens one time only. Okay, let's say they carried it back at 8%. That's our interest per year, right? 8% annualized per year. And they amortized it over, let's say they did 10 years. So 10 times 12 is 120 payments. It's fully amortized. So we're, for the balloon, future value, I'm going to put 0. Now we're just going to click on payment to figure out the monthly payment. Okay? So let's say you're happy with the property. You're happy that it's a deed state, not a mortgage, or if it's a mortgage state, you're comfortable with that already. You wouldn't mind owning this as a rental if you had to. And you found this on your own. And so you bought it at a 9% yield because your CD in the bank's getting you 1% or less, something like that. So let's say you're okay with a 9% yield, okay? And let's say they've already made a year's worth of payments. So what's that? 120 minus 12. There's only 108 payments left, okay? 9 years. You're okay hanging out 9 years. So I wonder what you would pay. So let's go over here and click on PV to figure out what you would pay for 108 payments of 606 each. So you would pay $44,793.77. And if you get 108 payments of 606.64, you for the next 9 years, you will be getting a 9% return on your money. And of course, each month as you get this 606, you can be accumulating it until you have enough money to invest in the next opportunity. So then you're actually compounding your money, but even if you don't, this is what you're going to make, right? Your 9%. Let's see what happens if what happens if in 5 years they refinance or they sell the property and pay you off. Okay, so let's figure out what that looks like. So now to figure out what the balance will be 5 years into this note, we have to go back to the original note. Okay, we have to recreate it. So 120, remember? 8, right there. And the original loan amount was $50,000. And let's just push payment again so that the computer has, you know, the number in it, because you know there's multiple digits out here that we're not seeing, right? So now I want to look at the amortization. So I'm going to click orange, my little shift key, and go up here to amortization. Okay, and it's going to tell me now it's I bought the note when there was already 12 payments gone. So now if they pay me off and refinance or sell the property 5 years after I bought it, what are we going to have? Let's just make sure, right? We have 120 and they already got 12 payments, and then we got a minus 60 payments. Okay, when there's 48 left, or when there's 12 plus 60. Okay, when we've received 72 payments, let's see what the balance is. I'm just going to put it in here. When I've received 72 payments, what's the balance on the note going to be? Okay, let's put that in there. I know you can't see this. It's really teeny. But down here it says 24,848.85. So let's just say 5 years after I bought this note that already had 1 year of seasoning, I'm going to get, and I'm going to make it a negative number because that's just what I always do to keep it straight in my head. Okay, let's say, then what is N going to be? It's only 60, right? I only got 60 payments of this 606.64 times 60, and at the end of that time I got the balloon of 24,848. Okay, and remember, what did I pay for this? What was it? 44. I kind of forget what I just paid for it. Anyone remember? I have to recalculate it again. Okay, 44. Oh, my pen's dead. Good grief. 793.77. Okay, so that's how much I paid. Now we're down to 60 months. Remember, I didn't know I was going to get paid off early, but I'm only getting 60 payments instead of 108. I'm only getting 60 payments of 606.64. And what's my balloon? I unexpectedly got a demand in the mail, and they said, please, escrow or title send you this thing. Please tell us how much you're owed. And you say, thank you very much. I'm owed 24, 845, 85. Okay, so you get that at the end. Okay, does everyone understand so far? 5 years in, you bought it at a 9% yield thinking it was going to take you 9 years to get all your money back. But instead, they sold the property after 5 years. And we saw that the end of 72 payments, that the balance was going to be this. So that's how much you were owed at that point. So now let's click on interest and see what we made. You just made 9.2. Okay, you see that it goes up. It's not super dramatic, but let's do this. What would happen if they paid you off? You bought this discounted note and they paid you off in 2 years. So that would be 1 to 36, right? 2 years, that you had it, and the 1 year that the owner had it, right? So now the balance there, that's going to be 38,921.35. I'm going to put that as a negative number. And I'm only going to receive 24 payments of 606, and then I'm going to get a balloon at the end of 24 payments. Now let's see what my yield could be. Oh, okay, good. My yield went up to 1032. So you can see that it only goes up. There's upside to it. Now, if you've bought something with an even greater discount, this is much more dramatic. In fact, I've had some scenarios where it's very likely I will double my yield. Okay, but you can see that there's a lot of upside from discounted notes where you're not going to have that unless you end up foreclosing on a property with a lot of equity, which is sort of unlikely, but not impossible. Okay, so that is all I had for tonight. So now, any questions? I'm going to try to unmute everybody. I wish I could unmute so I hope this helps give some perspective, because it's a little hard. Most people really want questions, chat questions. Did I miss something? Oh, there's Laura. You were in there helping me out and I didn't see it. Thank you so much, Laura. Good job. So anyone want to say anything while I'm unmuting everybody? Sounds like someone might be typing anything. But anyway, well, thank you so much for being on here tonight. Always appreciate you guys so much. And couple of announcements. The one-day class that I'm teaching got moved from Monday to Sunday, October 28th. And so if you're in the LA area, see if you can come to that on Sunday the 28th. So I'm really glad I don't have to do Monday anymore. And then other reminders is that if you go to the dashboard of your membership site, you will see all the links. That includes a link to a 30-minute one-on-one consultation. As a member of the community, you can use that and schedule me up to half hour at a time when you need something or just want to chat or just need something clarified. So please feel free to use that once a month. And if you have other stuff that comes up, email me and I'll do the best that I can to get back to you. So as always, really appreciate you guys, and we'll see you next time. Thanks so much. Oh, yeah, so Sabrina, I usually do discounted notes. It's rare for me to buy at a greater than 50% ITV. Yeah, I'm pretty conservative, and it's actually not that hard to get a lot safer on discounted notes than you would get at private lending. Oh, you're very welcome, Laura. Okay, thanks, Sabrina. You guys take care. Have a good one. Bye-bye.